When it comes to real estate, there is a truly extraordinary number of legal tax deductions that you can claim against your rental income. Let's explore what some of those are, because I think it's going to be an eye-opener for you. Let's talk about the many tax benefits of investing in real estate. So the government loves it when you buy real estate. In fact, the government loves it when you either start a business or buy property. Why do they want to encourage you to do these things? Well, the government realizes that if you don't buy enough properties that you offer to tenants as rentals, then the government's going to have to step in and provide housing for those in need. So they'd far rather have you do it than force them to do the job. And taxation, really, when you think about it, it serves two purposes. One is taxation is implemented to generate revenue. That's what the government needs to pay for border control and passport issuance and all that sort of thing. And the second reason is taxation is there to shape social policy. So to give an idea of what we mean by that, they'll put an extraordinarily high tax on cigarettes, not because they think they can gouge smokers for more money, but it's a way of discouraging smokers from buying cigarettes, because ultimately the government spends more money looking after their health. So they also give tremendous tax incentives to real estate investors to encourage them to invest in property so that the government doesn't have to do it for them. This is brilliant. That means you can take advantage of these benefits. Let's explore what some of them are in this video. The first deductible item we're going to consider is your home office. In fact, in order to take the home office deduction, there are two rules. Number one, it has to be used exclusively for business. And number two, you regularly have to conduct some kind of business there. And that makes sense why the government would require that. But if you meet those two conditions, then you can deduct the cost of your home office. And if you own properties managed by other people, like a property manager, then the income would be considered investment income, not eligible for the home office deduction. However, if you are actively managing your portfolio by overseeing your property manager, or maybe looking after the properties yourself, and the wealth you're accumulating, then that becomes your business, and the home office deduction is valid. Make sure you qualify. This is a huge deduction. The second obvious real estate related deduction is real estate travel. Real estate is everywhere. That means that there are opportunities everywhere to buy real estate. Now, what I'm saying is you can't go on holiday in Cancun and make sure you stop by a realtor shop and take a photo of yourself looking at some listings and say, yes, I was looking at real estate while I was in Cancun. That's why I went there. Chances are that wasn't why you were there. But in my case, I travel a lot with work. I'm speaking at events or looking at deals. And I genuinely do look at the properties available on offer because I do want to find deals that have a twist that I can buy, that I can invest in. And often I do. So in that sense, just about everywhere I go is a real estate opportunity that I'm investigating. So I encourage you to think of it in that light. It also means that there are real legitimate business deductions for real estate buying trips. If you're going to a place where you already own a property, then you're going there to either check on the property or check upon the managers. This is all tax deductible. Make sure you're accurate. You can't claim things you're not allowed to claim, but you should claim things that you are allowed to claim, and most people miss out on that. Make sure that you or your accountant goes through everything with a fine-tooth comb to make sure you're claiming every legitimate deduction that you can. The third deduction is kids. Now, I'm not saying you can deduct a kid because you've got one. This joke that you have more kids, that you have more deductibility, that doesn't work. We all know that having kids costs a lot of money. However, if you're a high income earner, then you've probably got a high marginal tax rate. And there's nothing wrong with you assigning your kids specific tasks, real estate related, that they can do. It could be anything from mowing lawns to making sure keys still operate or whatever. And you pay them for that privilege. It gives them a sense of accomplishment. It gives them a work ethic. And also because they've no doubt got a lower marginal tax rate than you do, then as a family unit, you'll have more money left over. I'm not suggesting you should put the money through them and then you take the money back. If you pay them, it's their money. You've got to teach them the value of earning money, right? But this is a great thing you can do. So you'll agree they cost money, but you can pay some of these expenses with before tax money by employing them to perform tasks for your business. These need to be legitimate tasks that are age appropriate, obviously. So number one, I recommend you have a written job description for your child. This is good because it gives them a sense of what they need to do to earn the money. Number 2, your child should keep a time slip or worksheet showing the hours that they've worked. That's also a great thing to do because they're going to face that in real life anyway. And thirdly and finally, pay a reasonable wage for the work performed. The wage has to be reasonable and age appropriate. You can't pay them $100 to go and check the mailbox. I think that wouldn't fly. Of course, anyone watching this in the future, they might think $100 is too cheap. Inflation's rearing its ugly head at the moment. In fact, we should talk about that at some other stage. But it's got to be appropriate for the task performed and the age of that person. This is a great way to train your kids the value of time and the value of money, and it's a great way of offsetting some of your high marginal tax rate into a lower tax bracket that your kids will no doubt enjoy. So number 4 is your automobile or your vehicle or your car, whatever you want to call it. There's a lot of money involved in running a vehicle. And it's often a critical part of your real estate investment as well. The business use of the automobile is deductible in one of 3 ways. Number 1, you can either claim so many cents per mile of actual usage. Usually to do this, you have to keep a log, not of every mile traveled, but a sample, a couple of months of the year to show you that in general, 30% of your use of the vehicle is for work-related purposes. The second way of claiming your auto expenses is a portion of a lease payment. And then finally, number 3, you've got a portion of the cost of the vehicle. So if you bought it outright, the cost of owning that vehicle, maintaining it, the road user charges, the registration, the warrant of fitness, or the exhaust emissions testing, all that costs money. You can claim a fixed proportion of that. Find out which one will work best for you, maybe in consultation with your accountant, and then apply it diligently. A bit of time, a few hours a year spent on working out how to claim your vehicle expenses is going to reap handsome rewards for you financially. The 5th deduction we're going to talk about is education. Education is crucial. We talk about constant and never-ending improvement, always learning more. Knowledge is like an island. The larger the area, the longer the coastline. The more you learn, the more there is still left to learn. That's why I'm continuously on a quest to learn more, to find out what else can I figure out to make this investment even better, to refine it. So when you do that, you'll always be looking at improving things. You can look at audio books or physical books, if you remember what they are, or seminars and events, or magazine subscriptions, and real estate investment club dues. They're all forms of education. Make sure that you claim not only the cost of attending these things or acquiring these things, but also the travel to them, the travel coming back, the accommodation to attend them. It's all something that will make a massive difference to your bottom line. And it's not just that you want to attend an event to be able to claim a deduction. You want to attend an event, and in addition to being able to claim the deduction, you might learn something that might increase your revenue by $10,000 a month or $200,000 a year. Always be willing to learn more. And I guess that's why you're here right now. And that's why I intend to deliver things to you all the time so that you say, wow, I never knew that. I'm going to incorporate that. And it improves your bottom line. That's what this game is all about. The next deduction we're going to talk about is depreciation. And I really love talking about this one because here's the thing. All the other ones we've spoken of, we've said if you spend money, then you can claim it as a legitimate expense incurred in generating taxable income. Depreciation, on the other hand, is something that you can deduct. You can get a tax benefit, and you haven't paid any money for it. Now, you can depreciate a building on the basis that with residential, for instance, it's assumed to have a useful life of 27 and a half years. So you can depreciate it linearly. It works out at about 2.8% a year. And that means that at the end of 27 and a half years, you've depreciated the entire value of the building. Commercial is considered to last a bit longer. It's considered to last about 30 years. So you can claim whatever it is, around 2.5%, and it will slowly go down in value. But the government's not so silly to think that buildings and houses actually do go down in value. They all know that, except for a few very minor deviations from the norm, things go up in value. So why will the government let you assume that it goes down in value when they know full well that it goes up in value? Comes back to what we were saying before. They use taxation partially to generate revenue, and the other major reason is to shape social policy. They want to encourage you to invest in real estate. And one of the ways they do this is by giving you very generous tax deductions. So what it means is that real estate is the only business that I know of where after you've made some money, there's net profit left over after all your cash expenses have been deducted. By the time you settle up with the tax man, instead of paying them money, they might still give you money. Let me explain what I mean. Let's say you've got a flower shop. You arrange flowers and put them in vases or whatever and sell them. And let's say after all your expenses, your rent and your electricity and your staff salaries and whatnot, you've got $5,000 left over. Well, then you could reasonably expect to pay tax on that $5,000. And if your tax rate is 20% or 1/5, then you'd pay $1,000 in tax and you'd end up with $4,000 after-tax profit. And now let's imagine you've got a piece of real estate. And after all your expenses like property taxes, insurance, and maintenance, you're left with that same $5,000. You might think that you're going to have to pay tax on that $5,000, but no. If you've got depreciation, if you've got $8,000 worth of depreciation, and you deduct that from your $5,000 net cash income, then you're at minus $3,000. And not only do you not have to pay tax on that, depending on how you're structured, that loss, that paper loss, because it's not a real loss, you made $5,000 profit, but that paper loss of $3,000 can be deducted against other income, and you effectively get a check from the government. Real estate is the only game I know of where even though you make a cash flow profit, when you settle up with the taxman, on paper it could look as though you're making a loss and the government sends you money. I love it. It comes about because of depreciation. You have to know about it. You have to claim it. You will never look back. This is one of the best things in real estate that I know of. Now, another way of increasing the value of a property is simply to do things to it to increase its value beyond the cost of making that improvement. Now, that's not strictly a tax deduction. We're actually spending money now, even though it's tax deductible. But I will tell you this, the cost of acquiring this book is tax deductible. And if I'm not mistaken, there are a good 101 ways of massively increasing the value of your real estate without spending much money. In fact, we have a way for you to acquire your own copy of this book free of charge. Just click on the link below. There is, of course, $7 shipping and handling, but even then, the cost of the shipping and handling, because it's improving your education, hopefully, it's tax deductible. There are tax deductions everywhere which enable you to improve your property, increase the cash flow, increase tenant appreciation, increase your ability to attract tenants, all the while spending less money than you otherwise would if you didn't make that deduction. Why would you not do it? The government's encouraging you to get on the real estate bandwagon. This is one of those cases where I'd say, do what the government says. It's a great thing to be on. Click on the link below to make sure you get your free copy of this book. So thanks again for watching. Don't forget to subscribe. I don't know if I can give you a deduction if you do subscribe, but subscribing does give you benefits in that it encourages us to make more of these videos. And remember also, check out my next video. If you enjoyed this one, I know you're going to like the next one.